Okay, ladies and gentlemen, if I can please have your attention, I'd like to start this evening's proceeding very soon and get on and talk about superannuation and what that means for us and how we can leverage. So, when I have your attention, we'd like to start. Thank you, Mr. President. Well done. Ahlan sahlan fikum and welcome to the Australian Arab Business Council's, I think we're in August, so this is our August event, not long left in the year. And it's so great to see you all here. You could be anywhere tonight and we're always happy to have you join us. First, I'd like to recognise that we're meeting on the lands, traditional lands of the Gadigal people of the Eora Nation. We pay respects to their elders, past, present and of course emerging. To those who are joining us for the first time, the Australian Arab Business Council, I mean, we're here to network, we're here to grow, learn a few things in the process and of course have fun along the way, and you'll definitely see that happening here tonight. So please do remember to enjoy yourselves as we go through the technical topic and of course as we network a little bit more. Now, with these meetings, this organisation is never able to make themselves happen without the support of our sponsors. So we have our platinum partner, which is Sam the Paving Man. We have our foundation partners, which is Arab Bank Australia Limited, affectionately known as ABLE, and our gold member, which is deputised through Sam Tyler. Can we please have a big round of applause for those category members? And we also do have KPR recruitment in that category as well, so I do apologise to them. You didn't have to give me the look, I felt it. Okay, so all good. All right, and then as our silver members, we have our PFS Financial, Freedom Care Group, Hampden and Associates, INB Bank, Advanced Timber, Flora Enterprise, G4M, Security Force, RM Gregory Promo Print, Architecture Design Studio and DATCOM. Can you please give a big round of applause to that cluster of members as well. Alrighty, so we have, it's always good to see a number of new faces here. I guess when we do change up the topics a bit more, it attracts quite a diverse crowd. And so we're really looking forward to hearing about superannuation and self-managed super funds. And with the week that I've had, I cannot wait to retire. So hopefully you can help us out with that pathway to get that happening soon. Before we do that, I'd like to invite our President to the stage, Mr. Rodney Hamdan, to give his presidential address. Please make him feel welcome.
Thank you very much. Thank you, George, for the introduction. My name is Rodney Hamdan. I'm the president. I've been president. This association actually was set up back in 2007, and I was president probably for half the time since then. So I've been president between 2007 and 2013, and again I was called upon for duty back in 23 and now in 24. I welcome you, members, visitors, guests, and really, I wish this number goes multiples of what we have tonight. You can see tonight we have a full house, and that's testament that you guys believe in us. The purpose of this organization is to basically promote affinity among our members, to promote business among our members. So those who haven't joined, there's a great opportunity to do business with fellow members. And on this side as well, it's a good forum to interact with family members. I have part of my family here, and I'm sure many of the guests here also have their family members. And last but not least is education. As we can see, the topic tonight is superannuation. As you know, superannuation is a very fundamental topic. It involves every one of us, and I'm taking tonight we're going to talk about specifically self-managed super funds. As you know, most of us in this room actually will not get the age pension. We will actually have to be self-funded retirees, and there's a lot of changes, particularly since the Labour government came into power a couple of years ago. There are 606,000 self-managed super funds on the books of the tax office. The assets of these super funds are $890 billion. So the average self-managed fund is about 1.5 million. Some of them could be small, some of them could be big. But what makes superannuation, particularly tonight in the context of self-managed fund, is a very critical aspect of our life, because our livelihood, our retirement depends on it. If for those who don't have self-managed funds, and for those maybe they will, following tonight, get into it as well. So I'm not going to steal the thunder of the presenters. Enjoy the dinner tonight, which will be offered after the presentation. The presentation, I'm sure, will be excellent. We've got a panel of 2 speakers who are quite seasoned in superannuation, and I'm sure they'll be getting a lot of questions, at least to start with me, but I'm sure there'll be, I was just giving them the heads up that there will be lots and lots of questions being asked tonight, because the change, especially that was done last year, actually, with the change of superannuation and the total super balance being more than 3 million, and the increase in rate, many things that impact those with self-managed funds. As I said, I'm not going to steal your thunder. I'll give the microphone back to Joel. Welcome, and I hope you enjoy tonight and enjoy the dinner. Thank you very much.
Fantastic work, Mr. President. Okay, so now I'd like to, I guess let's kickstart the event, and I'd like to call upon Farid Zaki and Stephen Marine. Is that right? I actually went up to him earlier and said, mate, how do I pronounce your surname? And I said, it's Marine. He goes, no, it's Marine. Marianne, and I still got it wrong. Thank you very much. So, for those who have been coming to these events long enough, will understand that no matter which surname you come from, what background you're from, I'm still going to stuff it up. So we all treat everyone equally. I think that's the point that I make over here. So Farid Zaki is a business accountant, tax agent, and founder of ATP Accounting Taxation Professionals, a business accountancy based in you're in Northwest Business Park in Borkham Hills. Over 30 years of remarkable business experience, Farid is passionate about helping clients grow their business and achieve greater profits, enjoy wealth, minimise tax, good on you, maintain cash flow, protect assets. He is positive-minded, as we see, passionate about business, being a business connector, and gets involved with many business chambers, networks and association. I always put in there, known as the king of selfies. Farid is a true gentleman, always open to new business connections and opportunities, and always pleased to reach out to him when you can. But he's right in front of us here tonight, so please welcome to the stage.
Thank you. I actually didn't know what Radwan said, that we are going to stand between you and dinner. So we'll try to be very quick, right? If you get hungry, just start beating on the chairs or something and we'll go very quickly. So the topic of the conversation today is about self-managed superannuation funds. When people come in and they want to create wealth inside self-managed superannuation funds, a lot of times it's really important that people understand that self-managed superannuation funds, it's really money that is in your investments. You need to make sure that it's invested properly. So people come sometimes and they say, okay, well, how can I use the super that I have to buy properties? So today I'll run very quickly from an accounting point of view, and then we will get Stefan involved as a financial planner to give us the insights from that aspect. So the first process when, of course, we've got to read the disclaimer, make sure anything we discuss today, it's general information. Please seek your accountant, your financial planner and business advisor to make sure that it fills your needs. Okay, so the first step when somebody wants to set up a self-managed superannuation fund is they need to go and see somebody like Stefan and Michael as financial planners, because setting up an SMSF is a financial product. So we as accountants, from a licensing point of view, we cannot advise on actually whether it is correct for the person to have self-managed superannuation fund or not. They need to go through the process, and Stefan will explain to us the process, where they basically look at the person, do a statement of advice, an investment strategy, and see how they can help them, and if the self-managed superannuation is a good situation for them. They organize, as a financial planners, they organize the rollover of the superannuation into the self-managed super fund and organize their personal insurances. Stefan will go into a lot of these details. I'll talk to you about what we as accountants can help with the setup and the running of the self-managed superannuation funds. So as accountants, the first step is once we have the statement of advice and direction from the financial planner that we can set up the SMSF, we can set up the SMSF, and SMSF is a type of trust, and it's good to have a corporate trustee rather than personal trustees for continuance. So if one of the members dies and you have a corporate trustee, you don't need to worry. The self-managed superannuation can continue, so that's why we always organize a corporate trustee. If they are, and then the financial planner will organize the rollover. Once they find the property, we need to set up what we call a bear trust or a custodian trust, which holds the relationship between the bank and the SMSF on a limited recourse borrowing loan, which effectively means that the bank cannot touch any other assets of the self-managed superannuation fund except that property that is set up. And we also set up a corporate trustee for that bear trust. And then obviously we do the accounting and the compliance throughout the year. So as I've explained to you with the bear trust, this is just a small diagram to explain the setup of a bear trust. All it does, it just holds the relationship between the SMSF and the lender in an environment where it's only the property that is actually can be accessed by the lender in this situation. So on a compliance point of view, every year we need to organize to record the income and the expenses of the self-managed superannuation fund. The income could comprise of rent, it comprises of contributions. Once you set up your self-managed superannuation fund, wherever you're getting your super, you direct them to make contributions into the self-managed superannuation fund. And obviously, if you've got money in the bank, you're earning interest. If you've got shares, you're earning dividends. So that constitutes income. And then you've got your expenses. If you've got a property, you will have the rental expenses. If it's got a loan, you will have the interest on the loan, plus also insurance like life insurance and TPD. Stefan will talk a little bit more about that. And all the general expenses of the SMSF. Main advantages of having a self-managed superannuation fund from a tax point of view, it's the environment that it's taxed on. So while you are under pension age, and that's what we call accumulation phase, any income you earn, including the contributions, the rent that you're receiving, it's taxed only at a 15%. Obviously, that's very attractive compared to the personal tax rates, which range up to 49 cents in a dollar. If you buy a property and sell a property and you have a capital gains, it's only taxed at 10% while you're at accumulation phase. The best part is when you reach pension, whether the rent ongoing, any income that you earn, or if you sell the property, you pay zero tax. So obviously there's a good tax environment for holding assets on the future. As a quick summary, we basically think about, from an income point of view, savings, investments, contributions constitute income, dividends and interest, insurances, rental and SMSF expenses, and then how can you use the SMSF to basically have tax effective strategies to build your wealth. And at the end of the day, you basically need to make sure that everything that you're actually doing, it's got to be both from a tax point of view, a good situation, but also from an investment and wealth building, it's really good. So I'll invite Stefan, and he will talk to you about all the financial planning side of things of the SMSF. Thank you.
Thank you.
Big one.
Which one?
The big one?
Big one? Okay. Here we go. Alright guys, thank you very much. Try not to take too long because I know everyone's probably hungry and wants the main course. And not to talk about superannuation on a Wednesday night. Just out of show of curiosity, who here has actually a self-managed super fund? Can you put your hand up? Okay, good. So numbers are growing. So just to add to some statistics of what Brad Wang was saying before, nowadays we're actually seeing a lot of people at a younger age category try and set up self-managed super funds from the basis that they just want more control. It's no longer a thing for the wealthy or for someone who's older with a bigger balance. Now we're actually seeing people with smaller balances, but they're saying they just want to create their own diversification, or they want to pretty much invest in a different asset class that normal retail funds probably won't allow. So, just disclaimer for the lawyers in the room, just up here. So for the next, could press a big button. So part of the process that we go through when we actually meet with a client is mainly establishing the appropriateness. So it's all good that you want to set up a self-managed super fund and go through the process and have that control, but is it actually appropriate to your circumstances? Now, we get the question all the time. People come to us with 100,000 and they say, is this enough of a balance for us to set up an SMSF? We look at it from a cost versus benefit ratio, because if you've only got 100,000, what's the point? Where someone like Radwan or Farid will probably charge you $2,200 ongoing to manage that every single year versus a retail platform which is probably going to charge you 60 basis points. So there's really kind of that cost factor that you need to weigh up. Do the members actually understand their obligations of being a trustee or being a member of that fund? We've had some recent cases now that the ATO have actually contacted the clients after they've set up an SMSF just to go through some questionnaires with them to see whether they're actually understanding their obligations when they've set this up. And it hasn't been someone that's just coerced them into doing it. So yeah, it's quite important. So you need to be a fit and proper person. I've added a basic checklist in there. And what are the long-term goals of the fund? Is it something that, you can't live in the property? Is it something that you want to carry on through to retirement? Is it something that you want to see into your pension phase? Are you going to have multiple assets within that? So these are all the questions that we tend to go through with clients to pretty much tailor a plan for their circumstances. And what are their personal risks? The last thing we want to do is put someone into a self-managed super fund to go and buy a property if they're not even being able to, maintain their own cost outside of the superannuation environment. By then having to then throw money into the super fund, especially if they're under a certain age, that's the last thing they want to do, lock money away before they can access it until the age of 60 or their preservation age, effectively. So, next step, it really kind of comes down to developing that strategy. So, prior to that, it's a combination of whether someone's balance can adhere to it, also past concessional contributions, and also what the proposed rental on a property would be. So as a result, before we even put pen to paper as financial planners, we tend to try and work with your lending professionals or your finance specialists to determine your lending capabilities. Because we've been many times throughout the situation where we go down the path of setting up an SMSF, people might have a balance, they they bring their wife into the fund, there's been minimal contributions from the spouse's perspective, and they go to the bank and the bank will only lend them a certain amount, and it's totally different to what their expectation was. So to not incur that cost, we'll try to obviously go through the process of getting the lending requirements up front first, and then to obviously formulate a contribution strategy. So then the next step is the advice process. So like Farid was saying, once we've determined that strategy, we will then formulate what's called a statement of advice. It's a detailed document which outlines each of our recommendations. So from rolling over the superannuation, establishing a CMA account, so a cash management account. So each SMSF has to have a separately managed cash management account. You can't just have it as a normal bank account that it's in your name or anything. From that, we would then ensure the members are offered or incorporate personal insurances. So that's part of the requirement now. So each member, every time you're joining a fund, you have to make sure that all your members are actually eligible to have personal insurances as an exit strategy. Then the next portion is establishing that investment strategy and that exit strategy, which is quite important, key, which we'll talk about that in more detail later on. Then we work with your accountant to actually establish the SMSF and the appropriate trustee structure. Prior to, I know Farid touched on it briefly before, people used to set up self-managed super funds with individual trustees and corporate trustees. Mainly what we see nowadays is corporate, especially if they're going to go down the path of buying commercial properties and whatnot. So you need to be registered for GST purposes. Then again, establishing the appropriate self-managed super fund cash management account, and then what we do is we roll over the money into that cash management account. So one of the things that is crucial to the actual SMSF space is having adequate personal insurances in there. So these are things like, life insurance, total and permanent disability, trauma insurance, and income protection. Of the 4 noted there's 3 of them that can be housed inside your superannuation. So life insurance, total and permanent disability. Owning them personally, you don't claim a tax deduction on. Inside the self-managed super fund, those things are tax deductible, or in super environment in general. Income protection is just tax deductible in both environments, but it can be housed within super, but we sometimes weigh up the option because depending on the person's marginal tax rate, it's probably better that they own it personally and claim the bigger tax deduction. So the next strategy, the next step is developing that investment and that exit strategy. The main part of it is determining what that end game is. We can't stress that enough because we see a lot of clients very gung-ho, go and buy a property or go and buy multitudes of properties inside super funds. They get to a certain age when they're at pension phase, the income cannot actually justify or pay for their actual minimum pension that they need to draw out. So that's something that's quite crucial. So having that diversification or that liquidity is quite important. And by having those conversations or working with a financial advisor, you'll determine, how long do you want to keep that asset? Do you want to fund it into retirement? Do you want to have all your risk in one asset or 2 assets, as opposed to having far more liquid assets? How long do you plan to maintain the debt? So sometimes when you go and borrow to buy inside a self-managed super fund, it's what's called an LRBA, so a limited recourse borrowing arrangement. When you go into pension phase, it actually gets added back as calculated as part of your TSB amount, so your total super balance. So sometimes that can limit your effect when you go into pension phase. So these are all the things that we would work with you to determine that you understand and to have a course of action with that property or that asset that you're buying inside the self-managed super fund. And will the strategy continue to meet your income needs? So meeting that minimum pension requirement. I've got a client at the moment, she's got 2 commercial properties, husband's just passed away. Fortunately, we had a corporate trustee structure, so just resigned him as a director. She became the sole director of that entity. The fund still maintains, but now we're getting to a point where she's having to draw out more income than what's actually being earned through the rental that's generated through the properties. So now we're starting to get to a point where we're probably going to have to liquidate assets. So these are all part of that exit strategy that you need to form. And also what we're finding, not just from a pension perspective, but when people are actually going and seeing lenders are actually asking for it now as part of their LRBA arrangements. What's your exit strategy? What's your investment strategy that you're going to have, and how are you going to afford to pay off this loan? So if someone's entering an LRBA at the age of 50 and they're going to have a 30-year term, well, how are they going to afford to pay that off? So they're going to want to have a strategy in place to say whether it's downsizer contributions, whether you're selling assets, whether you're putting extra funds into the superannuation account. How's that going to work? And so that's what we help the clients to formulate. So there's many benefits. I've kind of highlighted on a few negatives, but there's many benefits to owning property under self-managed super fund. As Farid said before, income is taxed at 15%. So owning a property that's positively geared in your personal name, chances are you're going to be paying more than 15% tax. In pension phase, so once you cease gainful employment, you've met your preservation age. So pretty much everyone in the room, that's the age of 60. The income that you earn from that property is capital gains tax-free and income tax-free. So that's crucial, that's pretty important. So you can own a property in your own name, you go and sell it later down the track, you're always going to have to pay tax. Inside superannuation, moving it to pension phase, CGT exempt. Pretty cool. So the next thing is it provides a degree of protection for assets. So self-employed, superannuation is protected from creditors. So owning assets underneath super is not a bad way to protect your asset. SMSFs are also eligible for land tax thresholds. So unlike a property trust or owning it under a family trust, you're going to be paying land tax at 1.6% from dollar to dollar, effectively. Buying real business property, so that's one thing that we've done actually. We own our office inside the Self Managed Super Fund. Our business Iconic Wealth rents it back from us. So you can actually do that. Where in a normal property, technically you can't live in it, family members can't live in it, can't reside in it, you can't have any benefit from it. But real business property, or business real property, sorry, you can actually enter into a proper lease agreement between your business and the Self Managed Super Fund and pay rent back to the Self Managed Super Fund. And it's a pretty good strategy. So, and it can provide steady cash flow in retirement without the volatility of other asset classes. So adding things like shares and managed funds, I know some people are pretty, adverse to that. But yeah, and it just provides that lower volatility and that steady cash flow. So the key takeaways in, I guess, the presentation we've just put forward is that have a strategy and regularly review it. Work with an appropriate financial specialist. Ensure you have adequate liquidity. Don't go and set up a self-managed super fund if you're going to have it down to the bone. So, if you're going to run a self-managed super fund, it's only got like 10 grand left in it. By the time you meet all your outgoings and all your expenditure, your insurances and everything else, you don't want to be doing that. Because the last thing you want to keep doing is having to shell more money to put in an environment that you can't go and access until you're 60. Or through death. And make sure you have appropriate insurances in place and be prepared to take control. That's the key part of it. So, all right. Any questions? Radwan, you have me excited. I thought there's plenty of questions. Okay.
Test. Oh, there we go. Thank you. Okay, so if we do have any questions, I think we'll take one from the back. Just before we do that, can I sneak a question in? So in terms of people exiting the self-managed super fund, let's say, you've got a spouse, you need to get rid of them.
Yep.
How hard's that strategy? Asking for a friend, not for me.
I love those ones that asking for a friend. Depends. Is your friend's wife around the same age as you, similar balances and things like that, or?
Okay, good one. Let's say it's a 75-25, so they've got the lesser portion.
The lesser portion?
Yeah.
Depending on what you own in the assets. So you might have to liquidate some assets to have that person then exit the fund.
Thank you for an excellent presentation, to be honest. It beyond expectation. Well done, you and Farid, on a fantastic flow of ideas. One thing I want to ask about, from 1 July 25, there will be a significant change in super, where that's right, the total super balance of more than $3 million, and I guess many of people in the room would fit in that category. The tax rate will be 30%, not 15%, on the profit pro rata. Can you elaborate more on this? That's something new, and that's only something happening a year from now. But I think it will have big ramifications on the way we manage super, because the limit used to be 1.6, now it's above 3 million, and I think really we're in for a rough ride when the tax rate's going to go to 30%, and some of that, the tax rate's not going to be on realized income. It may well. That's right. Yeah. So where we've got an asset which is valued at market value, and there's an unrealized capital gain, you have to pay tax on it. So you talked about the glamorous part of super, but that is the unglamorous part, and if you can just elaborate on this a little bit.
So you touched on 2 points there, Ramon. So the 1.6 refers to the lifetime pension cap, which is increased now to 1.9. So anyone can actually have up to $1.9 million in pension phase and pay zero tax on any of that earnings or any of that gain. So it's a pretty good structure to have. Now, what you're referring to is Division 296, which is what has been recently introduced. So anyone who's got a total super balance above 3 million, the way that it's going to work is that they're going to calculate from a 10% category at the end of the financial year, and of that 10%, tax will actually be earned or paid at that 30% tax rate. Now, the bad part about it is, like you said, it's based on unrealised gains. Or unrealised earnings. So the thing is, you might still own that asset, but based on a valuation or based on a portfolio evaluation, that's pushed you above that category. You may not dispose that asset, but you actually have to pay tax or come up with some form of a tax implication. So there's still a lot of much smarter people than myself still trying to navigate all this and still trying to lobby against it. But it is something that's pretty much on the card. So, yeah, it's very much watch this space. Any other questions?
Yeah, so if anyone has any questions, please do raise your hand, give me a wave, and I'll come around with the mic. So we've got two on the side. We have one over here.
Thank you so much for that presentation. This is also another asking for a friend question. He couldn't make it today. Now, mine's very general. You touched on, the amount to have, a certain amount to have, right?
Yep.
Before setting an SMSF, right? But I was just wondering, what's the most cost-effective amount? Or is there even a cost-effective amount? And does it get better as the more you have? Is there a particular age? Could you sort of touch on that?
So the beauty with SMSF, right, this is what I love about Self Managed Super Fund. I know it sounds a bit boring, but it's actually a fixed cost. So the more that you actually have a balance, the more affordable it becomes. So Self Managed Super Fund, like you're going to go see Farid or you're going to see Ramon, come and see us. To do the management side of it, it's a fixed cost each year. You're going to have someone to do the bookkeeping of it for the transactions. You're going to have someone to do the ASIC fee or the audits, do the tax returns, all that kind of stuff. And it's generally around $2,200. Versus if you're in a retail platform, whether it's CBUS or whoever, they're going to charge like 0.6% of your total fund balance. So now if you look at it, if someone's got 100 grand, they're paying $600 versus then someone's going to charge them $2,200 each year. So there's no real hard line, fast rule about what your balance should be. I don't even think the ATO put an actual figure, do they? No. So generally speaking, when people come and see us, we would say normally have around that 250. Now, just because you have 220 and we're not going to take you, no, but we would obviously work with you for a strategy to try and build your balance up to that actual amount. So whether it be through contributions, whether you've disposed of an asset and we try to minimise some of your CGT, your capital gains tax in your personal name, put that in your super. Better in your name than paying 15% as opposed to giving it to the tax man. Sorry if there's anyone.
Can I also just add another point as well? I think in the environment of the SMSF, what really makes it really good is you're able to gear the money that you have. So obviously if you have $200,000 sitting in a fund, that's all you have, $200,000 sitting in a fund. But if you are able to borrow another $200,000 and buy property worth 400, or even not buy property, invest that 400,000, obviously the return on 400,000 should also be better. So that's another benefit, I don't know if Stefan will agree with me, is that you are able to gear. Because when you are gearing, obviously you've got to cover your costs, but as long as your return overall is better than what it's costing you with the gearing, it gives you that extra advantages to at least double your money.
Thank you so much, Farid and Stephen. I want to enhance on the member. Is it member $3 million or the fund?
So each member.
Each member. So if there's 4 members, it goes. The threshold will be built up on that. Yeah. I have a question just regarding fund. 2 couples together, they opened super fund. One of the couples having issues with the family. So if anything happened to that couple, what's going to happen to the fund? And there is a property, commercial property under that fund.
That example you just, that's more of a kind of like a family law type of situation, but I've just actually had the same situation now. Mm-hmm. The last thing you kind of want to do is, especially if there's other business partners involved, so if they're running their business out of that premises.
Yes, they are.
Yeah, so it's a common issue. Then it kind of disrupts other people within that business, or whether other business partners or associated business partners. The best thing is to try and mitigate between both members and try and see whether there's other assets that can be used to pay out that person to offset them having to then sell that asset that's inside the Self Managed Super Fund. And that's what we've just done with the client now.
Can be the payout outside the fund?
Well, what they can do is they say that I give up my superannuation portion to my spouse as part of the agreement, and I'll take more of an asset over here in the personal name. Because all the assets go in. Correct.
But would be able the outing party, the wife or the husband, can they force the fund to sell the property? Is there anything under the law to force them?
If they want to, yeah. If they want to say that I want my actual balance back out, yeah. Because this is like a family law situation. They will force them to do that.
Okay, thank you.
Yeah, the courts will push for that to occur. But the best thing is to try and mitigate that as much as possible. And that's where you then say, pay out the asset through another means, and that person can keep that. There's got to be an element of, being pragmatic, effectively.
Thank you.
Hi. Thank you. That was great. That was a great presentation. That was really helpful. Just following up on that point of you have a marriage breakdown and you have the investment of the property in the names of 4 people effectively, or their members. Is there an insurance policy that could mitigate that risk? Is there a policy that would, like a partner policy or an agreement that they could put so they could... No? There's nothing? Okay. All right, that's good.
Just a little bit of an advice. Just kill them. Case closed.
I don't think you'll even have to worry about your super then. But the key in all this, and it's good that you're asking these questions around that kind of topic. This is one of the reasons where and again, each person's different that you'll get advice from, but I'm very against having your kids part of your fund for that reason. So, yeah, if it's you and your spouse, common ages, people that will probably enter pension phase at the same time, all these things, it just makes the job so much easier. So if you look at my presentation, it's all about strategy. It's all about forward planning. The last thing I want to do is create more of a headache for myself and for you come retirement time, where then I've got to then go get actuarial certificates because this member's under a certain age, this member's in pension phase, it's headaches. You want to try and keep it as simple as possible.
But it can be done, isn't it?
It can be done, but
It can be minimised.
I can drive home without my headlights on too tonight, but it's not advisable, you know what I mean? So, same thing. It can be done.
I guess following on that point, it can be done. We can segregate the assets. We can have a segregation within the fund so that asset can be owned by this particular member.
Well, depends on you can't if it's just over one fund because it's a pool, but you can actually set up multiple SMSFs.
Oh, yeah.
So if you wanted to then alleviate that condition, when we've got that, I've got a client that does that. Him and his wife, he's got his own SMSF, she's got her own, because it's just purely based on risk appetite. They can't agree on the actual investments. He's wants to go into crypto, wants to go into all this stuff. She doesn't want any of the money subjected to any of that. So, double sets of fees, but that's your insurance there effectively.
Thank you so much for that presentation. That was very informative. Look, I'll just make this a very quick one. So my husband and I are now new into this SMSF realm, and there is a lot of information to take on, so it's quite risky for us. You did mention before that the younger generation now has started to take on this SMSF journey. Given that the younger generation is now taking on this journey, what would you advise as, I want to say, the key considerations or risks in the next, say, 10 years when the SMSF trustees are looking at managing their own super funds, over the next 10 years, what are the key risks that we can take into consideration?
So, it's a good question, actually. So from a young perspective, the key risks, I would say, is make sure you do have diversification. Don't have all your funds just in that one asset class or that one asset, all right? Try to have a multitude. So, like I said, I gave the example. We own our office inside our Self Managed Super Fund, but I also have ETFs. I also have things like managed funds. I also have shares. And I'm not just going to rely on that one asset, because then if I do go into pension phase and I'm pretty much relying on that income, that's only from there.
Yeah, okay. Because we saw, of course, in May, we didn't really know what the changes were going to be as super until the budget came out. And it was a bit of a surprise. Oh, these are the changes relating to superannuation. Yeah. So we don't really know what changes are going to come up in the next 10, 15, 20 years. So I'm 38. I'm not going to be drawing out on my super for another 40 years, maybe 30 years.
The key, so it's another 22 years. But,
oh, 22, okay.
So
60, okay, good.
The key that I always kind of look at and I always say to people is that the government's going to encourage you to put money into super, right? They don't want you to take their money. They'd rather that you survive on your own money and be independent.
Yep.
So there's always going to be that encouragement or that benefit in order to be able to have the tax incentives to make it viable for people to throw extra money into it. The thing that I would always say to young people starting out, try and make contributions or try to max out your contributions every year.
Okay.
The sooner you can do that, the better. And the more that you can then obviously own assets within inside the Self Managed Super Fund, the better.
Okay, awesome. Thank you.
You're welcome. And seek advice too, yeah. Valid point.
Sorry. If you have 3 or 4 partners in a super fund, super managed super fund, and one of the partners passed away, what happens to the assets, their portion of the assets? And do they have to dissolve the super fund?
Do you want to answer that? I feel like
So the first thing is it depends if they are individual trustees or corporate trustee. If they are individual trustees, then yes, you have an issue. Yes. But if you have a corporate trustee, it can move on because the directors that are remaining take over. Obviously, you've got to have enough funds to make the payments, the death benefits, and things like that. So if it's individual trustees, that has to be resolved.
Just follow up. What about if
That's why we are actually encouraging people to do corporate trustees, because you have continuums.
Yeah.
But two other points in regards to that. So if someone is actually still in accumulation phase and they pass away, that's the importance of having life insurance. So you can actually pay out a death benefit, right? Because the fund has to pay something out. And if that person's in pension phase, what you want to have is what's called a reversionary pension. So if we're both in pension phase, myself and my wife, that pension reverts to her and hers reverts to mine, to me, upon my death. So then that way, nothing has to be sold, nothing has to be exchanged, and just the pension amount simply transfers to me and her. So.
All right. Just before we get on to the last one, I've got a question. Same friend, same situation again. If they had a will, would that be able to help out in the situation where the money goes in the self-managed super fund?
If they have a will?
Yeah.
What do you
the story got to be gruesome, so...
The person, well, you just got to have death benefit nominations. That's the key.
So the will, by the way, the death nomination inside the supersides the will. The will not necessarily decides who gets the super. This is a very important. Yeah. So your superannuation is treated separate in the case of the rest of the estate in your will. So it's very important to have a death nomination election of who you want the money to go to.
Sorry, one last question. Actually, I promise you. I gave you heads up that you're going to be very popular. There are going to be many questions. My question is, with the differential rate between the superannuation fund at 15% and the company tax rate at 25%, there's obviously advantages to accelerate the contribution. Can you discuss a bit more and alert the visitors here or the guests too about the catch-up contribution? Contributions used to be 25, went up to 27.5, and next year actually there'll be 30,000 again, which means even if you're on a $100,000 salary, you can actually contribute $30,000 next year, which means the fund can get that income 30K, but the company will get the tax deduction at 30,000, and you can benefit from that. And the beauty of it is that you can go back 5 years. If you can just elaborate on the catch-up provisions, yourself or Farid, about the shortfall in contributions, so that you can actually maximize the tax deduction in your company tax return by going back 5 years to claim the maximum amount.
Alright, so Farid can talk about the company tax rates. So one of the things that the government introduced after COVID was catch-up contributions, which was actually a pretty cool thing. So if you haven't maxed out your contributions, your SG contributions, so your pre-tax contributions since 2018, 2019 financial year, they're allowing you to do those as catch-ups within that year. So for example, since 2019, if someone's just made 15 grand and the cap was, say, for simple mathematics, 25, right? You've got $10,000 that you can catch up from that financial year in this year. Now, if you haven't done it for the last 5 years, that could be effectively $50,000 plus this year's contribution. So, which is a pretty cool thing, right? So, one of the things that what we've done in the past is when people dispose of an asset in their personal name, and this is where you need to definitely get good advice. If you dispose of an asset in your personal name and is going to be subjected to capital gains tax, instead of paying that CGT to the government, make part of that CGT as a contribution into your fund and get the tax offset. So there's a lot more to it than KPIs, but that you obviously got to satisfy. But yeah, it's get advice at that point.
And obviously, what Radwan is alluding to, so if you're paying it out of your company, you're getting a tax deduction. So putting it into the super, you're taxed at 15%, the company gets a deduction and saves tax on 25 cents in a dollar. So you're winning on both aspects. Sorry, can you say that? What paperwork needs to be done by the super fund about that? The extra contributions. So obviously it's going to be a reportable contributions. If the salary is not up to the same amount, it needs to be reported as reportable superannuation. You put it up.
S290, the S290 form, the notice of intent.
Intention to claim. So from a fund, you're talking from a super fund or you're talking from a company level? So. Yeah, that's S290, which is basically the intention that you are claiming a tax deduction. So the trustee has to pay tax on it, and you claim a tax deduction on it. John, I was waiting for you to ask a question.
Only that I wanted confirmation that when a member passes away, the asset that is inherited is subject to capital gains tax, not?
Is the asset inside the super fund?
Yes.
If the asset is in the super fund and they are on pension age, and you sell the asset?
No. If I die and leave it to my children,
yes,
my children will pay capital gains tax on the sale of the asset.
It depends if they are financially dependent on you or not. If they are,
so depends under the SIS Act to be a dependent, you have to be under the age of 18, spouse, or someone with like an intellectual disability. Now, if your children are no longer dependent under the SIS Act, so above 18, adults, financially independent, there would be tax on that benefit. It wouldn't be CGT, but they would actually pay non-dependent tax. So it actually works out 15% plus Medicare levy, so 17% tax on any taxable element. So untaxed or tax-free element, that's still tax-free. You get that benefit tax-free.
I'm sure that adult inheritors, beneficiaries of your estate, are going to pay tax at 15% only?
Only on the self-managed super fund.
Yes.
Yes, because it's super tax rate. So 15 plus Medicare levy, so 17%.
And because they are not financially dependent on you.
So the key, what was your name, sir? Sorry? John. So John, a lot of the people, what we tend to do, so that example that I gave you, the one where the husband's passed away, the wife's inherited 2 commercial properties inside the self-managed super fund, we had a reversionary pension. So it's transferred to her straight away, tax-free. She still receives the pension. The SMSF's purely in her name now. So now I've got an issue where we're starting to navigate back to strategy, all right? She's got 2 adult sons. If she is to pass away now, they'll have to pay tax at 17% on the benefit. So what we're trying to do is to liquidate the assets now. And so she's got cash. She then rips out the actual benefit and it's in her personal name. Son 1, son 2. See you later. No tax.
Excellent. All right. Thank you very much, gentlemen. Thank you, Stephen, and thank you, Paddy Zaki. Please give me a big round of applause. All right. We're going to take a quick break for dinner. Then after this, we'll listen to our group from Trademark to help us look at, maybe if you don't want to invest in self-managed super funds in Australia, Might want to go to Saudi Arabia, could be a good option. Well, you know what? I think next time we might talk about trust funds in the Cayman Islands. Anyways, enjoy your dinner and we'll talk soon.